Hello everyone, welcome to today's US Open live webinar 10 minutes before Wall Street opens. It is Thursday, February the 15th. I'm your host Nikos Tsabouras, Senior Financial Editorial Writer at FXCM. This has been a week of that had many economic releases, and this continues today. What we will focus is the technical recession in the UK and Japan, based, of course, on today's preliminary figures, and how the respective currencies reacted. And we also had the International Energy Agency raising its supply growth forecast for this year, something that keeps oil prices under pressure following yesterday's big jump in inventories in the US. And of course, we're going to talk about more things as usual, like Wall Street and Euro USD. But what I just mentioned will be in our focus today. Before, however, we begin, as always, please read carefully through the risk warnings and the disclaimers. Okay, let's get the ball rolling. We're gonna start off with the GDP figures from the UK and GBP versus the US dollar. Then we're gonna talk about the Japanese growth figures. Both economies entered into a technical recession, and of course the USD JPY outlook. We're then going to have a quick update on Euro USD, which rebounds today. We're also going to talk about US oil because we had the latest report from the International Energy Agency around supply and demand outlook, and we're going to round things off with the Nasdaq 100, which seems to like the poor retail sales figures we got earlier today. Now, let's start with the UK economy. Of course, we shrunk by 0.3% quarter over quarter in the fourth quarter, according to today's preliminary data. This is the second straight quarter of contraction, which is generally considered the definition of a recession. But once again, these are the preliminary figures. This likely strengthens the case for rate cuts by the central bank because prolonged restrictive monetary stance does more harm to the already ailing economy. And we see that the pair faced some pressure today, but overall it's a bit mixed and inconclusive. The news come after a bad week because inflation data from the US worked against the pair, and the ones from the UK also worked against it because markets focused on the sharp deceleration of the monthly figures despite persistence of inflation in the old Albion. Of course, we have covered all of that in the previous days. Now, the pair once again tests the pivotal 38.2% Fibonacci that we have said can support the pair. Of course, the fact that testing this level brings the 1.23 handle in the spotlight, but we feel that this is still quite distant, and a strong catalyst would be required for this to be endangered. But for now, immediate bias is on the downside. As we have said, the 38.2% Fibonacci is pivotal, and even if breached again, we also have the ascending daily Fibonacci, daily Ichimoku cloud, which can provide support in case of renewed pressure. If the cable manages to defend that level again, this will keep the December highs in prospects for an advance towards this will be kept alive. That's the 1.2828 handle, but the pair would need to take out the 200 period EMA first exponential moving average at around 1.2650. And you can see that the RSI is rising, but again, a good signal here would be a cross above the 50 line. Now let's turn over to the US dollar versus the Japanese yen. The Japanese economy also entered into a technical recession, again based on preliminary data, as it contracted by 0.4%. This could be supportive of the pairs, the increased chances for the Bank of Japan to prolong its ultra-loose monetary stance, but we're actually seeing that the pair is facing some pressure today, probably as a result of the recent rally. This has brought the one. This has brought it closer to the 152.20 resistance, which is the highest rate since July 1990. And the reason, of course, for this rally is the fact that markets are coming to grips with a more reserved approach of the Fed around rate cuts, and of course the sticky inflation we saw this week. Now, however, this pullback that we're seeing, and given fear that there could be an intervention from Japanese authorities, be it verbal or actual FX intervention to support the yen, means that there is scope for further pullback that would test the 200 period EMA at around 147.6. Of course, daily closes below that would be required for the bullish momentum to pause, but strong catalyst would be needed for that. Upside bias is clear, but further gains are likely going to be incremental given the factors that we discussed, meaning the fact that the central bank in the US takes its time around cuts, and the Bank of Japan is also taking its time towards doing the opposite, towards raising rates. And of course, prospects of intervention are always there. We have seen that happening both verbally more often and less often as an actual FX intervention. Before we switch gears and talk about oil prices, let's have a quick update on the euro dollar. We can see a robust rebound today. We had said that these levels here could support the pair, and that's what we're seeing. Talking about these levels right here. And we're also seeing on the RSI that it has crossed well above the 50 line. So as such, we can see an effort to return above the 200 period EMA, the black line here. And daily close above it would pose the downside bias, but the common currency does not inspire much confidence for sustained advance that would take out the next hurdle at 1.1017. Overall, this seems to be more a reaction of the dollar rather than of the euro, as we're seeing the dollar showing some exhaustion following the recent surge. But in any case, a bias remains on the downside below the 200 period EMA, and this continued retreat has exposed the pair to the 76.4% Fibonacci, but sustained weakness below that does not look particularly easy. As we have said before, the monetary policy differential is a bit murky, and as such, direction on either side, big moves on either side may prove elusive. Now let's go to US oil. Has made a constructive start to the year. Why? Because Middle East hostilities create supply disruptions, or at least fear of such disruptions. We've talked again about that thing before. We're seeing rebels from Yemen, the Houthis, which is considered a terrorist organization by the US, hitting ships in the Red Sea, ships and tankers, and that is supportive of oil prices. The commodity tries to leave behind it the pivotal 38.2% Fibonacci and look to the 84.9085 handle, but we are cautious around the upside because this advance is a product of supply concern, not demand creation, which can cap any gains. In fact, today the International Energy Agency maintained its demand outlook, its 2024 demand outlook for a growth of 1.2 million barrels per day, which is nearly half of last year's expansion. So definitely, yes, expansion, but very limited compared to what we had last year. It believes that the agency believes that supply could eclipse demand this year, and in fact raised its projections, expecting supply to increase by 1.7 million barrels per day. And along with Wednesday data from the US that showed a massive build in inventories last week, US oil faces headwinds. This creates scope for further losses towards last month's lows, a little above the 71 handle, and a rejection of the 30, another rejection of the 38.2% Fibonacci. You can see how it has rejected it 2-3 times this year. That could eventually open the door to a